thank you for joining us today for our great new webinar, Getting Started, How to Buy Your First Property, Getting Into the Market. It's the biggest step arguably anyone takes in their life, certainly from a financial perspective. It's the biggest first step and hopefully the first of many steps to come for you in your property investment journey. Welcome, my name is William Mitchell. I'm the head of property here at Ironfish. I'm really passionate about the property markets, and today I want to help educate you as to how you can take that first, sometimes daunting step and get onto the property ladder and hopefully start the climb to what is a very successful property portfolio for you. Now, we've got plenty of content to go through today. I really want to make this as easily absorbable for you as possible, because I remember when I bought my first property, and I have to say I was overwhelmed. I love property, I always have, but even taking the first step for myself was a difficult one. And it was only because I had the support of some key people around me that really enabled me to get into the market and go on to much, much greater things from that point in time. So I look forward to talking a little bit about my own personal journey and hopefully sharing some really valuable insights for you as to how you can get your foot on the ladder and hopefully up the next few rungs as well. Now, for those of you who are new to us, I did want to just talk to one or two slides about Ironfish, who we are and what we do. We've been around for 16 years now. We've helped over 12,000 customers, both owner-occupiers and investors, invest in residential real estate across Australia. We operate across the 6 largest cities, being Sydney, Melbourne, Brisbane, Perth, Adelaide, and the Gold Coast. We've got offices across the country as well, so it doesn't matter where you are, what time zone it is, we can be with you, not only face-to-face, but also nowadays with the likes of Teams or Zoom. It doesn't matter where you are or what time it is, we're happy to sit down and talk to you and help you in your property investment journey. And we are indeed, we believe, to be the #1 property investment educator in Australia. Now, in terms of what we do, we really want to make this process simple for you. And these are 4 key areas where we assist our customers in getting into the market, holding on to their assets and growing their portfolio over time. And we provide a huge amount of knowledge and information from a market research perspective. So we provide you with all sorts of reports on the markets, on different product types, on the projects that we select, and we give that to you free of charge. We want you to feel informed. We want you to feel empowered so that you can make choices and invest with confidence in real estate in Australia. So we provide you with a huge amount of market research. We assist with investment strategy, how you can best build your portfolio, manage your cash flow, and take advantage of different property cycles in different markets across the country. We also look after property selection. So we have a huge range of different residential projects across the country, whether that be house and land, townhouses, or apartments. We've got something to suit your needs. And then once you've settled on that asset, we're able to assist with managing your properties and your portfolio with ongoing consultations with one of our very experienced strategists, as well as property management across the country too. So we really provide what we believe to be is a very full service offering that makes this property investment journey easy and straightforward for you. Okay, so today we're going to cover a lot of content. We're going to look at the pros and cons of investing. We've got some really interesting stuff in this. Particularly, I want to focus today on the power of leverage, compound interest, and what that can do for the rapid growth of your portfolio. How much do you need to invest? How much will it cost to hold on to those investments or properties? Getting started, how do you actually get started? How do you do it? Common mistakes to avoid, there are several. They're fairly easy to avoid, but you need to know what they are in order to avoid them, and that can save you many, many thousands of dollars, if not hundreds of thousands of dollars, by avoiding some of these common mistakes. And then setting up your goals, understanding what your strategy is, and how we can help you get there. So now, before we get stuck into the content itself, there are a couple of slides that I want to talk to so I can help understand where our viewers are tonight in their journey, in their property investment journey. Now, there are several stages of property investment and indeed of life. We like to call them the learning, the earning, and the retirement phase. So the learning phase, obviously the early years of your life, maybe through to 18 or 22 years old, where you're studying, you're at school, you might go to university if you choose. But you then move into what we call the earning phase. And that's, from your early 20s, hopefully through to your mid 60s, if not earlier. And that's obviously around really increasing your income, paying off your home loan, investing, whether it be in residential real estate, spending time with family, education, all of those things we need to pay for, but it's also really important to ensure that you carve out savings and money to invest so that when you retire, and as I say, 65, maybe it's earlier than that, you've got some good assets that are providing you with a really healthy income that makes those golden years really, really enjoyable for you. So you can travel, you can spoil the grandkids, and you can spend money on lifestyle, whether that's a new car or a holiday home on a regular basis. For first-time investors, first-home buyers, it's such a daunting process to get your foot on the ladder. And there are really three key hurdles to this. The first of which is, of course, knowledge and experience. Once you've done it, once you've been through the process, the second time round and the third and the fourth and the fifth time round is going to become increasingly easy because you understand how to secure a loan, you understand finance, you understand the cash flow of owning an investment, obviously legal knowledge, knowledge of the markets, the product. So having that knowledge, experience, and importantly, confidence to buy real estate is such a big thing. So that's a key reason why the first one's the hardest, because you don't have that knowledge and experience. The second one is building your A team. And this is a really important one because property investment, unfortunately, it's not always easy. It's not always straightforward. It does come with challenges, but that's ultimately why it's so rewarding. If it was easy and you could make good money, everyone would be doing it. But trust me, not everyone is investing in residential real estate and they're not investing aggressively enough. So it's really important to build your A team. Ensure you've got a really good property expert on your side. And here at Ironfish, that's certainly something that we can offer. Our property strategists have many, many years of experience in residential real estate investment. They own large, significant portfolios. They understand the different markets around the country, and they can really help you through this process, through this journey. So it's really important to build your A team. That's something we hope to be a big part of. It's also really crucial to have a good broker or a good banker on your side, a good solicitor, and maybe we could add a fourth bullet point in there being a good accountant as well, but that's probably something that comes more into play as you start to build your portfolio. But obviously, as a first-time buyer, you won't have that set up. You won't have your A team yet, but by the time you come to your second investment, you'll have that set up. You'll know who's been good for you in the past, and maybe if you want a new broker or a new banker, at least you now know how to go about that process, how to find that person. Number three is saving a deposit. Now, when you're looking to get into the market, when you're looking to get your first step onto the ladder, for most people, it involves good old hard-fashioned saving. And that can be a very, very lengthy process. Whereas with the benefit of already owning property, you can use existing equity. And this can really turbocharge your ability to get into your second property. And I'll highlight this with this big box on the right. How long does it take? So the question is, how long does it take to save $50,000? Well, ultimately, it depends how much you're earning. For some people, that might be 2 years, 3 years, 5 years. Maybe it's 1 year, maybe it's longer. But for most people, it takes quite a long time to save $50,000 because we pay tax, we pay rent, we pay bills, all sorts of things. So to actually save $50,000 can take some time. And I certainly know for myself, it took 2 years of solid saving for me to be able to build up the deposit that I required to get into the market. Now, once you've got into the market, let's say you've got a $500,000 property, you've now, not only are you saving yourself, but you've also got an asset working for you. And so if you've got a property of $500,000, how long does it take to grow by $50,000? And if we said 5% growth per annum, $25,000 a year, it takes 2 years. So if you've got a $500,000 asset and that's growing at 5% per annum, it takes 2 years to do that. And if you're saving as well at the same time, you might be able to afford to buy your second property in 1 year or 18 months. But let's say you're not saving and you're just relying on the growth of that property. It'll take you 2 years for that property to grow in value by $50,000. And then you can then refinance that equity, pull some equity out of that asset to fund your next purchase. And I'll go through this in detail later on tonight. It's actually probably my two favorite slides of our presentation, is explaining this process of withdrawing equity out of one asset in order to purchase another one. And this can have a real big impact on your ability to go from 1 to 2, from 1 to 3, from 1 to 4, from 1 to 5 properties. So it's a really important process that I want to make sure you understand today. Now, if you were to own 2 properties, let's say you've built your portfolio, you've now got your own property that you're living in and an investment, or you might just have 2 investments and you're renting. You've now got 2 properties valued at $500,000. Well, if they're both growing at 5% per annum, which is $25,000 each, it only takes 1 year. And you don't need to save anything anymore. So you can start to spend more money on lifestyle as opposed to saving every single dollar, eating baked beans 7 nights a week. You've now got 2 assets that are able to generate a new deposit for you in the space of 1 year. And as you continue to increase your portfolio, that process becomes shorter and shorter. So if you've got 3 properties valued at $500,000, it takes just 8 months to grow in value, assuming they're all growing at 5% per annum, in order to generate that additional $50,000. So the more properties you own, the faster it is to save a new deposit or create equity that you can use to fund the purchase of a new property. So the first one's always the hardest, team. It does get easier from there, I promise you. Now, pros and cons, we'll run through these because some of them are pretty straightforward. I'm sure you'll all understand these. But some of them I'll spend a bit more time on. Now, the first one is rental income. Rental income is a huge benefit of owning an investment property. And I've got some of my friends who they haven't yet got to the stage of buying an investment. They might have their own home, but they're concerned around buying a second property because they don't believe that they can pay for a second mortgage. And for most people, that's true. But with an investment property, you have rental income, and that rental income will generally pay the vast majority of the mortgage, if not all of the mortgage, and some additional costs associated with the property. So it's really important to understand that rental income helps you pay for your asset. The tax man also helps you pay for your asset, and I'll come to that later in our slides. And you may have to put in a little bit of money. It might be $20 a week, $30 a week. It might be $5 a week. Or you might not have to put in anything to own that asset. So rental income is really important. It's a huge benefit of owning an investment because ultimately the tenant is paying for the bulk of the costs associated with that property. Now, not surprisingly, capital growth, big benefit of owning investments. This has created massive wealth for the vast majority of Australians who've owned at least one property, if not 3, 4, 5 properties. But it's important to understand that the more real estate you own, the more capital growth you're going to be exposed to over time. So capital growth is absolutely crucial, but what you need to understand is that you need to own property over the long term in order to see the real benefits of capital growth. And this is something that a lot of property owners get wrong. They don't own property for long enough. So we're going to talk to that a little bit later, but you need to understand that holding over the long term is the most important thing. Now, let's take a look at some examples around the country. Let's take a look at Perth as a starting point. Now, a lot of people in Perth and a lot of people in different markets across the countries experience varying levels of growth over time. Okay, so we can see here that values have increased from $210,000 up to $584,000. So this is really very good growth over the space of a 20-year time period. But as you can see, the majority of growth happened in this initial phase. Okay, so people did very well in this period. They've experienced a little bit of sideways movement. The market's come down a bit, and now it's starting to grow again. And Perth is arguably the best positioned or the most affordable market in the country at the moment, and the next 10 to 20 years are looking very, very bright from a capital growth perspective. So it's important to own over the long term. It's also important to diversify so that when one market is going or is perhaps a bit flat in terms of its growth, you're exposed to growth in another market. For example, Sydney. When we take a look at the Sydney market, we can see that the market trended fairly sideways for close to 10 years, but then it's taken off and it's doubled in the space of 10 years. But again, for those investors with a long-term mindset, we can see if you bought in at 472 and it's now worth just shy of $1.3 million, you've made some really, really good money. Now, Brisbane, we'll take a quick look at Brisbane. Again, you can see Brisbane's actually had steady-ish growth over time, and obviously some tremendous things over the past 2 years, and certainly the next 10 years in the lead up to the Olympics, the Brisbane Olympics, some very positive things to come for Brisbane. And then Melbourne has had a fairly steady run throughout its 20 years, but for those investors with a long-term mindset, you can see they've more than tripled their money in the Melbourne market. So capital growth, a really big part of this. It's really one of the key reasons, if not the key reason, that people invest in real estate. But the important thing is to understand is you need to own over the long term. Okay, tax benefits. Now, there are 4 key tax benefits that I'm going to talk to: depreciation, negative gearing, capital gains, tax discounts, and tax deferring. So let's get stuck in. Tax usually isn't a very sexy subject, but when it comes to property investment, it's actually very sexy, because property investment, the government has set up property investment to make it attractive for you from a tax perspective. And the first part of this is tax depreciation. This is absolutely crucial to understand as a property owner, and specifically as an investor, as opposed to an owner-occupier, because investors get some really, really attractive tax incentives for investing in residential real estate. Now, the first is depreciation. And effectively what this is the government views investing in residential real estate as if you are running your own business. Now, if you're running a business, and let's say you've got a florist and you own a florist and you've got a van to make deliveries across your local area, the government will allow you to depreciate or claim that van as a tax deduction because it is going down in value. The government allows you to do the same thing with the bricks and mortar of the asset that you own, or the investment property that you own. So although the overall property value is going up, because the bricks or the dishwasher or the blinds are decreasing in value, you can get to claim that as a tax deduction, which ultimately makes it it makes it easier for you to hold on to that asset as the years go by, because you're getting tax back from the tax man. So this really helps to improve your cash flow. But what's crucial to understand is that the greatest tax depreciation benefits are on new properties. They're not on second-hand properties. So if you were to buy a new property, you can claim capital works, which are the bricks and mortar, the fixed items on a house, as well as the plant and equipment. Now, plant and equipment is basically the things that are not necessarily attached to the house. So things that can be easily removed, such as blinds, taps, dishwashers, air conditioning, etc. Whereas for old properties, you can only claim capital works deductions. So the bricks, the roof, the timber frame of a house. And this is actually a huge difference. So it's really important to understand this. And I'll show an example. So this is actually a personal example of mine. On the left is a brand new apartment that I bought. I bought it off the plan through Ironfish in Melbourne. And because it's a brand new apartment, I could get depreciation in my first year of $12,000. So when I went to do my tax, income, expenses, all that at the end of the financial year, I got a tax deduction of $12,000. So let's say I was earning $100,000. I could basically say to the tax man, well, I'm actually earning $88,000 because this has depreciated in value by $12,000. So that would mean I get tax back on that $12,000. Now, in year 10, this happens for every year over 40 years. In year 10, I'm still claiming $9,000 in tax deductions Over the 40 years, it slowly decreases. The amount that you can claim back decreases, but you can see after 10 years, I'm still getting $9,000 in tax deductions, which is a huge amount of money. Now, let's take a look at the first property I bought, which was my first home that I lived in. It's an apartment in Lane Cove. Now, this is an old building. It was about 40 years old when I bought it. And as a result of that, the depreciation was very small. So in the first year of ownership, I could only claim $3,000, whereas over here I claimed $12,000. And in the 10th year of ownership, I claimed $486, which is basically nothing, whereas here I was still able to claim $9,000. And when you think of a tax bracket of 30 cents in the dollar, I'm basically getting $3,000 back from the tax man after 10 years for holding this asset, in the 10th year of ownership, I should say. Whereas over here, I'm not really getting that. So depreciation is a really big factor, and it's important to understand that new property gets you much greater depreciation benefits than old property, as you can see very clearly here. Now, the other thing that I want to highlight for you is the rental yield. And this is really important to understand from a first home buyer perspective or a first time investor perspective, because the rental yield on this particular apartment is very strong. So let's assume that both of these assets are worth $500,000. Actually, let's go up. Let's say they're worth $1 million each. Over here, I'm getting a rental return of 5.4%, which equates to $54,000 in rent on my $1 million purchase. Whereas over here, it's a lower rental yield, so I'm only getting $34,000 per annum rent compared to $54,000 over here. So to break that down, that's an additional $20,000 I'm getting over here compared to here. Now, on a per week basis, that's an extra $400 per week I'm getting with this asset compared to this asset. And I'm also getting much greater depreciation or tax savings through here. So let's say I'm on a 30% tax bracket income. I'm getting an additional $4,000 per annum back in tax, which is $80 a week. So I'm getting $400 more through a stronger rental yield and $80 more through greater depreciation. So in this asset, this is cash flow positive by $400 to $500 better for me than this one is. So really important to understand depreciation, old versus new, and also rental yield, strong rental yield versus a softer rental yield. Okay, let's keep moving. All right, negative gearing. So this is a bit of a complex term. Certainly I was overwhelmed with it when I first started investing, but it's an important one to understand. Now, negative gearing when you're investing in property means that all of these items you can see here, you can claim these as a tax offset, okay? Now, if I'm living in my own home, I'm not allowed to claim mortgage. My mortgage bill is a tax deduction. But the minute I move out of my home and I turn it into an investment, I can now claim the home loan interest as a tax deduction, which could be many thousands of dollars. So there's a real benefit in investing as opposed to owner occupying, because all of these things that you see here, these can be tax deductions which help to reduce your cash flow or reduce the burden of owning a property, because all of these things are tax deductible and you're getting effectively money back from the tax man from this. Okay. Now, what this means is, what the simple concept of negative gearing is that when your outgoings are higher than your incoming rent. So let's say you factor in your mortgage repayments, council rates, body corporate rates, property management fees. And let's say all of those things come to $20,000 per annum, but your rent is $18,000 per annum, or the rental income that you're getting. So that's a shortfall of $2,000 per annum. Now, the great thing is, again, the government sees this as a business. So that $2,000 loss you could claim as a deduction, and the government will give you tax back on that against your personal income. So let's say it's costing you $2,000, you'll get maybe 30 cents in the dollar back. So you get $600 back from the tax man on that $2,000. Now, some people will see this and they'll think, well, why would I want to do that? Why would I want to hold an asset that's costing me $1,400 per year to hold? It's very, very simple, and that is capital growth. So it might be costing you $1,400 to hold, but if it's growing by $20,000, $30,000, $40,000 per year, that greatly outweighs the $1,400 that you're paying to own that asset every single year. So that's the attraction of negative gearing. You're getting a tax offset, so it's easier to hold, but the capital growth is not being taxed unless you choose to sell that asset. And we'll talk to that in a, well, here we go. So if you do decide to sell an asset, then you will get taxed on the capital gain, okay? But if you choose not to sell the asset, any capital growth that you get, you don't get taxed on, and you can refinance to effectively pull money out of that property to buy another property. And I'll talk to this concept shortly. But firstly, if you do decide to sell an asset, you have capital gains tax that is payable. So let's say you bought an asset for $500,000 and it grows to $1 million. You sell that asset, you've made $500,000. Now, usually you would pay a full tax on that. Let's say, again, your tax bracket is 30%. The government would take 30% of that capital gain. So $500,000, they take 30%, which is $150,000. However, there is a very attractive benefit in place for property investors, and that is that tax gets cut in half, providing that you have held onto that asset for 12 months or more. So if you've held it for a minimum of 12 months, the government won't tax you $150,000. They'll cut it in half, and you'll only pay $75,000 in tax on your $500,000 capital gain. Okay. Now, ultimately, you don't want to sell, so then you don't have to pay that $75,000. But sometimes you have to sell, or you need to sell, then you have to pay that tax. Now, having said that, if it is your own property that you live in, it's your own home, then you don't have to pay capital gains tax. And that's one of the key benefits of owning your own home, is that, let's say, again, you buy it, you live in it for 10 years, it grows in value from 500 to $1 million, you make $500,000, you don't have to pay tax on that because you have lived in it yourself. All right, tax deferring. What is tax deferring? Well, again, this is a really great part of property ownership, and that is what I've just talked to. You're getting capital growth, and that capital growth, you don't have to pay tax on it until you sell. Now, for very, very savvy investors, they buy good quality assets that they plan to hold on to forever. So they never plan to sell, and they simply draw equity out of that to buy their next property. Okay, and I'll talk to this concept shortly. And over time, they pay down the debt on that asset, the rent goes up, and when they retire, they hold on to the property, and the rent simply replaces their income. Okay, so by not selling, you're deferring paying tax. You actually don't pay tax until you sell, which is a massive benefit of investing in property. Okay, leverage. Leverage was, for me, one of the key things that drew me to property investment. And that is because I could leverage my money far greater in property than I could in other assets. So the example here, let's say I've got a $100,000 deposit in property. I can leverage that 5 times quite easily, up to $500,000. So the bank will lend me the additional $400,000. Whereas, let's say you were to put $100,000 into Bitcoin or some sort of cryptocurrency, a bank is not going to let you leverage to the same value. They're not going to give you an 80% loan to invest in something of that nature, whereas with residential real estate, you can. So that's the benefit of leverage. And then you've got a $500,000 asset that's growing in value, as opposed to just a $100,000 asset that's growing in value. So let's say that it grew at 5% per annum. If you'd invested $100,000, it would be growing by $5,000 in that first year. Whereas with a $500,000 house, it's growing by $25,000 in that first year. So much, much greater growth because you've leveraged your money into a bigger and better asset. So leverage is a really important one. And then leverage combined with compound growth has a massive, massive benefit for investors over the long term. And this is why I was saying earlier, it's so important to understand the long-term benefits of capital growth and what that can do for you financially. So let's say that you've bought an asset for $500,000. Let's say you've bought a house. You've got a deposit of $100,000 and your loan is $400,000. And let's say you don't pay off $1 of that loan. So the loan stays the same year on year on year on year. But over time, the value of that asset increases. And we've said here it's growing at 5% per annum. And you can see that over the course of 40 years, that growth gets greater and greater and greater. And after 40 years, the property's worth over $3.5 million. And all you've had to do is put in $100,000 deposit. Okay, the loan hasn't changed, that stays the same. So your $100,000 has basically turned into $3.5 million. Now, let's minus the loan from that, and we're basically talking $3.1 million. So you've grown your $100,000 to $3.1 million. And that is the benefit of leverage and compound growth. Okay, let's talk to what I believe is the most exciting part of this process. And first home buyers, first time investors they're not necessarily aware of this. And this is what enables you to get from one property to 4 properties very quickly when it feels like getting from 0 to 1 takes forever. Okay, so this is a really important point. Now, I wanted to talk about the very first property that I bought, which was this one here. Now, I purchased this when I was pretty young. I scraped and saved every penny I could for 2 years in order to buy this 2-bedroom apartment. Now, when I bought it, I actually moved into this. It was an owner-occupier residence. And the reason I did that was to get a $7,000 grant from the government. Now, today, in different states, there are varying amounts, but there are some very, very attractive incentives on offer for first-time buyers to help them get into the market. So I lived in this property for the $7,000, but after 6 months, after I'd done what the government needed me to do, I actually moved out of this property. And the reason I moved out was twofold. Firstly, this suburb, it's a great suburb, Lane Cove. It's really leafy, very friendly, very family-oriented. But for me, at this point in time of my life, it wasn't actually where I wanted to live. I thought it was a great place to invest and I could afford it, so I got into the market. But then when I lived in there for 6 months, which is what I needed to do to get the $7,000 grant, I moved out and I went and lived in Newtown, which is a different part of Sydney, much cooler for younger people. And I turned this into an investment property and I became what is called a rentvestor. And a rentvestor, for those of you who don't know, is someone who owns real estate, but they rent themselves. Okay, so they're renting, but they're also an investor. And this enabled me to live the lifestyle that I wanted to live in an area that I wanted to live in that I actually couldn't afford to buy in, whilst also having a really good asset in a really good area that I could afford. And by not living it, I also got the benefits of depreciation, tax offsets, which made this an easier property for me to own as to if I'd been living in it personally myself. Okay, so this is my story from becoming an owner-occupier to a rentvestor. And then let's look at how I use the equity from my first property to turbocharge me into other assets very, very quickly. So let's take a look at this. So my first property, it cost me $525,000 for a 2-bedroom apartment in Sydney. Now, my deposit was $105,000, which is a 20% deposit. Okay. Now, 6 years later, the property market had done some amazing things. I'd actually bought property within that 6-year period, but I've just simplified this to ensure that you understand the concepts that we're talking about. So 6 years later, the property had increased in value from $525,000 up to $800,000. So I was a very, very happy young rent investor. Now, what that meant is my equity had also grown because the loan hadn't changed, just the value of the property had gone up. So the equity that I had in the property had grown from $105,000 to $380,000. Now, the equity that I actually need in that property is only $160,000. Okay, the bank was happy for me to just have 20% equity as opposed to this, which is close to 50% equity. Okay, so the bank said, look, you can reduce your equity in here. We'll increase the size of this loan up to $640,000, and you can pull out $220,000 of equity to use for a new purchase. Okay, so what happened was the loan on this increased. I still held the asset, and I now had $220,000 to play with. Now let's look at what you could do with that additional $220,000. So I had the $220,000. I wanted to buy a new property, so that $220,000 had to cover a 20% deposit, and it also had to cover about 5% in purchasing costs, which is stamp duty, solicitor fees, maybe some bank charges. So I needed to factor this into my calculations. So 5% and 20%, when you do the maths, it basically means I've got a 20% deposit of $176,000, and I've got $44,000 to cover stamp duty, legal fees, etc. Now, if I've got a 20% deposit of 176, we times that by 5 to get a total property value of $880,000. So purely by buying that first property, owning it for 6 years, letting it grow in value, pulling equity out or refinancing, I could now buy a second property valued at $880,000 now. So what I've been able to do in the space of 6 years is grow my portfolio from $525,000. This asset is now worth $800,000, plus the new property that I bought at $800 or $880 means my total portfolio is now worth $1.68 million. And what's really powerful about this, guys, is that once I got this first property, I didn't have to save. Now, I still did. I still chose to save, but I could save maybe a little bit less than I was before. So instead of having baked beans 7 nights a week, I only had baked beans 3 nights a week, and I could afford the occasional beer and maybe a holiday as well. So that's the power of growth. That's the power of equity, refinancing, and that's how you can get from 1 property to 3 properties very, very quickly. And the more property that you have and the more that it grows, the more you are able to do this process. And so your portfolio can really balloon. It can get very big very quickly, which is really exciting. But unfortunately, the first one is the hardest. And that's why people, when they get the first one, they think, I don't want to go through that process again, so I'm not going to buy a second. But guys, this is how easy it is. This is how it works. Okay, so it's important, now that you've got this knowledge, it's important to think bigger. And this is something that most investors don't do. They get their hands on their home, they maybe buy an investment, they maybe buy 2 investments, but they don't think big enough. And unfortunately, having 2 property investments for the vast majority of Australians is not going to provide you with a comfortable retirement when it comes time to retire. So it's really important to have, we believe, to have at least 4 properties, investment properties that is outside of your home, in order to give you a comfortable income on retirement. Now, another great part of real estate is that it is a relatively stable asset class. And again, if you hold over the long term, history has shown that property values go up, providing that you're in a good quality location with strong demand. And that's what the capital cities offer. That's why we love sticking to the 6 largest capital cities. They provide regular ongoing stability and growth. So stability is really, really important for your assets to ensure that you're always growing in time. Okay, so next, how much do I need to invest? How much money do you actually need to get your foot on the ladder? Now, let's take a look at some of the main costs. As a first-time buyer, or really for any property owner, the main deposit that you need is a 20% deposit. Now, quite often you might be able to get a 10% deposit. Sometimes you might even be able to get a 5% deposit if you're a first-home buyer. So that's the biggest cost that you need to factor in is the deposit itself and stamp duty. Okay, now stamp duty varies depending on which state you're in, but if you generally allow for, say, 5% of the value of the property, that's usually what the stamp duty cost is. So if you factor in about 5%, Then some other costs that you may need to factor in are legal fees, lender's mortgage insurance, which is basically an insurance policy if your deposit is less than 20%. Now, unfortunately, that insurance policy doesn't cover you. It actually covers the bank. But it's an insurance policy that you need to pay if you have a deposit less than 20% in case you default on your loan. The bank then has insurance, but it's something that they make you pay as opposed to them paying, which is frustrating. But if it allows you to get onto the property market sooner, because you can then pay a 10% deposit as opposed to a 20% deposit, then there is definitely some benefits to that. But it's important to understand how lender's mortgage insurance works. And so having a really experienced property expert or strategist on your A team, as we like to call it, is really important. Mortgage fees, loan application fees, building and pest inspections, settlement inspections, and a tax depreciation. These are some of the additional costs that you need to think about. They are small in nature. Lender's mortgage insurance can be a bigger cost. It can be several thousands of dollars. But the rest of them are generally, a few $100, maybe $1,000. But these are things that you need to look into. And again, that's something that we can help you with. We've got this experience, we've got this knowledge, and we can make it a really easy process for you. Now let's have a look at an example. Let's have a look at a one-bedroom apartment in Melbourne. This particular apartment, we're looking at a purchase price of $495,000. Now, this is actually a project that Ironfish has access to today. So if you would like more information on this really beautiful building, fronts onto a racetrack, beautiful views of the CBD, please do let us know. But let's look at this example. Purchase price of $495,000. Assuming you need a deposit of 10%, your deposit is $49,500. LMI, which is that lender's mortgage insurance I was talking about, because your deposit is less than 20%, you need to pay LMI, which in this case is $9,900. But it's important to note that that is only payable when you go to secure the loan. So this is, again, one of the benefits of buying off the plan, which is where you sign a contract today, but the building isn't yet built. You might settle in 2 years' time. So you pay a deposit of $49,000 today, but you have another 2 years to save for LMI. You might need to pay the solicitor fees up front. It also gives you 2 years to save the stamp duty and loan costs of $1,000. So all of these fees ultimately amount to $87,000. But if you're looking to buy off the plan, buying new, it may only be as much as $49,500 plus the $1,200 when you purchase, and then you've got another 1, 2, 3, maybe even 4 years to save the LMI and the stamp duty and the loan costs. So that's actually a really great way for first-time buyers, home buyers, or investors to get into the market, is to buy new, because it buys you time to continue to save. So that's an example of how much you might need for a one-bedroom apartment in Melbourne. Now, how much is it going to cost me to hold? This is a really key component of this that you need to understand, because it's all well and good going and buying a piece of real estate, but if you can't hold on to that asset, it could be very, very costly for you. So it's important to understand what the costs are that you're going to have to pay for every month, week, year, and ensure that you can pay those, ensure that the rent that's coming in is going to cover those costs. So some of these common holding costs are obviously mortgage repayments, council and water rates, landlord insurance, body corporate fees, if applicable, property management fees, accounting fees, building insurance, repairs and maintenance, and potentially land tax. So all of these things you need to have an understanding about. And again, this is why it's important to have an A team, have a really good property strategist, have a great accountant, a great broker, and a great solicitor, so they can help you understand all of these fees that you may need to consider. So let's take a look. Once we've put all of these fees into a calculator, and at Ironfish, we've built our own calculator that does all this, so we can show you very clearly what it's going to cost you to hold an asset over 12 months, 5 years, so on and so forth. So this particular example, we're looking at a new 3-bedroom townhouse in Brisbane. Again, this is a project that we have available today, a purchase price of $585,000. We're looking at a weekly rental income of $548. We've got property costs of $710, so that's your body corporate, your mortgages, insurance, all those things. It's costing you $710 per week. But you're also getting a tax saving because of depreciation and because the outgoing costs are more than the incoming costs. You get a tax saving of $166 per week, which means that the asset is actually making you $4 per week. So it's basically costing you nothing to own this property. It's actually putting money back in your pocket, albeit a small amount of money. It makes it very, very easy to hold on to this property over the long term. Now, every property, every person's situation is different. It depends on your income. It depends on the rental yield, the expenses of the property. So it's really important to sit down with someone who's got really good experience. And again, our strategists are able to help you there and calculate all of this cash flow so you can see what it is going to cost you to hold on to a property over a 12-month period. Okay, let's talk about strategy. Now, when you're looking to buy real estate, it's really important to create a strategy and understand what you're looking to achieve. Now, if you're a first home buyer or first home investor, quite often that's it. That's all you want to achieve, and that's a fantastic goal. Getting on the ladder is the most important thing, and from there you can look at your longer term future goals. But there are lots of different goals. Reaching a passive income goal, that's my long-term goal. I want to have enough real estate paid off so that I can have that income, that rental income, replace my wage so that I can retire comfortably. You might be looking to minimize tax as a higher income earner, working to a retirement goal, easy to hold investments, buy and hold long-term approach. So there are different strategies and different things will influence how you approach your investments. So again, this is something that you need to be speaking to an expert about, and that's certainly something that Iron Fish can offer to you. Now, you might be thinking, approach, how do I actually get into the market? And there are multiple different ways you can do that. You can be a straight first home buyer, which is where you need to save, which can take years. It can be painful. It does require sacrifice. I did it myself, and I'm really glad I did, because while my friends were out partying, I was saving money. I got onto the property market far sooner than most of my friends. And that has benefited me greatly because, as you saw in those earlier slides, I saw good growth over the first 6 years of holding that property, and it enabled me to really grow my portfolio, whereas some of my other friends still aren't even on the property ladder yet. So it's painful, but it's worth it. You might become a rentvestor, which is ultimately what I did. So I rented my investment property out, and I became a renter myself. You might turn to the bank of mum and dad, who might look to co-own a property with you, buying with family and friends, although I wouldn't recommend buying with friends because things can go awry quite quickly. So maybe with the bank of mum and dad, or just continuing to work hard and save those dollars, that's a great way to get onto the ladder. And once you've got that first one, getting to the second, third and fourth becomes a lot easier. So once you've got your strategy set up, you know what your approach is, the next key step, absolutely key, is understanding how much you can actually borrow. And this is something that a lot of people get wrong. They don't go and find out how much they can borrow. They instead go and look for the property that they want. And they spend months doing that. They find the property that they want only to find out that they can't actually afford it. So understanding how much you can borrow is crucial. This can be done by speaking to a good banker or a good mortgage broker. And if you don't have access to one of those, please let us know. We can put you in touch with a really good broker. We've got some of the best in Australia working with many of our clients. So it's definitely something we can help you out. And they can help you understand exactly how much of a loan you can get and how much savings you're going to need in order to get onto the ladder. It's also important to understand what type of loan structure do you want? Do you want to be paying interest only or principal and interest? Now, for those of you who don't know what these two things are, if you're paying principal and interest, it means that you're paying principal, which means you're paying the loan itself off. So let's say you borrow $100,000, you're paying off the $100,000, and you're also paying interest. Okay, so the bank will charge you an interest rate, might be 4%. You're paying off that 4% every year, but you're also chipping away at the $100,000 to get that down. whereas paying interest only means that you're not paying down the $100,000, you're just paying the 4% interest every year, okay? Now, as an owner-occupier, you actually want to be paying both. You want to be paying the principal down, whereas an investor, you really most likely only want to be paying interest only. And the reason for that is it improves your cash flow because you're not paying this off. Your weekly cash flow becomes better. And the interest component that you're paying every year is a tax deduction, whereas for owner-occupiers, it's not a tax deduction. So most owner-occupiers pay principal and interest, and most investors pay interest only. Now, it is a bit of a confusing concept, so again, please reach out to us if you want some clarification on that, because it is a really important point to understand. Okay, next, you found out how much you can afford. It might be more than you thought, it may be less than you thought. Once you figured that out, you have to understand, where should I buy? Where can I afford to buy? A great example was my own personal experience. For my first investment property, so I had my property in Lane Cove. The next property that I was looking to buy, I went to the bank, I figured out how much I could afford to spend, and then I tried to find that in Sydney, in my own city, okay? Because I was familiar with Sydney, I knew it, and it felt safe. And I spent months looking for something in Sydney until one day I realized I just couldn't afford the Sydney market. The bank wasn't going to give me enough money to get into this market, so I had to expand my mind and think of other areas, okay? So that's what I did, and my next purchase was actually in Queensland. So I went to a different area that I could actually afford to buy, and for many first home buyers today, this is something to consider, because you may not be able to afford a property in your ideal location, but explore different locations. It might be a different area in your own city, or it might be in a different state, but it enables you to get onto the property market. You've got an asset that's growing in value, and in the meantime, you might be renting where you want to live in your own city. Okay, so that's considering interstate, and it also is avoiding home bias. And this is something that most investors get wrong. So most investors, when they go to buy an investment property, they buy what they know. They buy their own city because it's familiar and it's safe. And that's what I was doing. I was buying Sydney because I live here and it felt safe. But actually, the best thing to do with my money was to put it into another market, because that market was due for some really strong growth. And so that's what I ultimately did. I put my money in a different market. So important to avoid home bias. Look for locations with strong growth potential, so that you can withdraw equity and buy another property and grow your portfolio. And also, crucially, ensure you look for good rental demand. You want a strong rental market, and fortunately today, most markets across the country are very strong rental markets. And the benefit of a strong rental market is it means you will usually always have a tenant, and it also makes it easy for you to hold on to that property, because the cash flow is very strong. The rent that they're paying you is very high, so that it's easy for you to hold onto that asset. Again, just looking where you can afford to buy, it's really important to expand your mindset, expand where you look to invest, because different markets are doing different things at different times. So as you can see, Sydney really took off during this period, whereas other markets were a bit soft. And then, in these later years, you can see Brisbane really taking off, while other markets are doing different things. So it's important to expose yourself to different locations. Now, in terms of research, this is something that Ironfish is really passionate about. My head office property team loves research. We love understanding what's happening in the different markets across the country. And all of this is information that we provide to you for free. So we'll provide you with information on the markets. We're just about to release our My City 2022-2023, which is a great document to help you understand what's happening in each of the capital city markets across the country. There's information on how to buy off the plan, how to buy a new property. We provide individual reports for each of the projects that we present to you. And then we've got our really powerful property calculator, which I'll talk to in a few slides' time, that helps you understand how the cash flow works for a particular investment. Then we need to consider which type of property should you be buying, a house or an apartment, a 1 or a 2-bed or a 4-bedroom, regional versus capital cities, and second-hand versus off the plan. So this is when you start to get a bit more granular, and this is where it's really important to ensure you have experts around you, and it's important to listen to people who are successful investors. Don't listen to people who haven't done it, who haven't been successful, because trust me, there are plenty of friends, plenty of family, plenty of colleagues who will give you bad commentary on how to invest because they aren't successful investors themselves. So it's important to listen to those who've done it, who've been successful, and try and block out the noise from those who haven't been successful at it. And that can be hard because it might be loved ones, it might be very dear friends or very dear family members, and you want to listen to them, but it's important to understand, have they themselves been successful, and therefore should you be listening to the supposed words of wisdom that they're providing to you. Now, here at Ironfish, we've got a full team, not only in our head office, but in each of our offices across the country who know the markets intimately. And in terms of the projects that we look at, we have a massive checklist of due diligence that we need to run through before we put a project in front of you. But these are some of the key things that we look at. Locational essentials, population, infrastructure, employment's crucial. Is it affordable real estate? Is there strong rental demand? And then the properties themselves, are they the best quality in the market, from the best developers? Do they have really strong owner-occupier appeal? And we also go down to detailed contract terms and conditions, what's included in the property for you. So these are some of the things that we can do for you. We like to think we provide a huge amount of value to our customers, and hopefully we'll have the opportunity to show that to you soon. Now, it's also important to understand what incentives are on offer around the country, because different states will provide different incentives for first home buyers. And as you can see here, up to $32,000 for first home buyers in New South Wales, $31,000 in Queensland, $41,000 in Victoria, $15,000 in South Australia, and up to $60,000 for first home buyers in Western Australia. So if you're in one of these cities, it's important to understand what the government has on offer to help you get into the ladder. And this is an amazing thing to take advantage of, where, as I say, when I bought my first property, my first home, the government gave me $7,000. And now in Western Australia, you can get up to $60,000, which is absolutely massive. So really crucial to understand what those things are. Now, we would love to have the opportunity to take you through our PPA 2.0. Now, for those of you who don't know, the PPA is this amazing cash flow calculator. It's a piece of software that we've designed and built, and it helps you to understand the cash flow of owning an investment or owning your own home. So it inputs all the factors that you need to consider: mortgage payments, insurances, maintenance, all those things, and you can see how owning a property or 2 properties or 4 properties is going to impact your cash flow. So we'd love to have the opportunity to take you through this amazing tool. And if you would like that opportunity, please do pull up your camera, scan the QR code on the slide that you see here, and we will be able to speak to you about that calculator. But we will also be able to send you to our first time investors guide to property, how and why investing works. And this has got some additional information on top of what we're going through tonight that will help you get into the market. So please do scan the QR code there. We would love the opportunity to talk to you, whether it's tonight or over the coming days, and help you get onto the ladder and begin your property investment journey. Okay, common mistakes to avoid. There are some really key ones. Wrong strategy. I know I made this mistake myself. I bought a property with a really low rental yield, and it was a very old property, so it had high expenses. And as a result of that, I couldn't hold on to that property because it was costing me too much money to keep it. So it was the wrong strategy, it was the wrong property, and ultimately I sold that one because I just couldn't avoid it. Whereas if I'd had some more advice or some more direction from a professional, I could have avoided that. Selling too early. Many investors sell too early. So they might make a little bit of money and then they sell because they think a profit's a profit, but they might miss out on a lot more growth to come. Listening to the wrong people, as I said earlier, this is a very common mistake, really problematic. So ensure you listen to professionals, listen to successful property investors, because they're the ones that have done it and they've been good at it. So listen to them and try and cut out the rest of the noise. And then waiting for the perfect time, waiting for the perfect time to jump into the market. And this is, I've got a really close personal friend who was looking to buy around the first time that I was, and they actually waited and waited and waited, and they waited 10 years before they actually bought. So they were in the market 10 years after I was, and as a result, they missed out on a lot of capital growth, not only on that first property, but on subsequent properties that I bought while they were still sitting on the sidelines. So waiting for the perfect time to buy, it doesn't exist. There's always going to be a reason not to buy, but it's just crucial to take that first step, take the leap of faith, and get into the market. Okay, and then be prepared. It's really important to ensure that you know what's coming. You've got a long-term mindset, so understand that when you buy a property, you're not buying for 12 months, you're not buying for 24 months. At an absolute minimum, you really want to be buying for at least 5 years, if not 10, 20, or even just holding on to the asset indefinitely. The longer you hold, the more money that asset is likely to make for you. So really important to have a long-term investment mindset. Be prepared for unforeseen events or unforeseen costs. I remember when I bought my first property, I thought I had everything covered, but then sure enough, $5,000 went straight out the door. I didn't have a washing machine, I didn't have a dryer, I had to replace the water heater in the property, and very quickly my cash buffer disappeared. So ensure you've got a good cash buffer for things that you haven't encountered for. Be prepared for entry and exit costs. It's important to understand that buying a property is expensive because you pay thousands of dollars in stamp duty, and then selling is also quite expensive because you have to pay agents' fees, advertising fees, and then if you buy back into the market, you have to pay stamp duty again. So it's important to understand that entry and exit costs are quite expensive. And so when you buy an asset, you really want to be buying it, planning to hold it for a long time so that you minimize those entry and exit costs. And then the fourth one, interest rate changes. Interest rates go up and down. When I bought my first property, I was paying 7.29% interest. Today, interest rates can be anywhere from 4.5%, 5.5%, maybe a little bit more. So it's important to understand that interest rates can change. Be prepared for them to go up. When they do come down, fantastic. It makes life a little bit easier, but you do need to be prepared for interest rates to go up. And again, our property cash flow calculator can help you understand how that may impact your journey. Okay, investment goals. It's important when you start investing to have some really strong goals. And quite often people have the wrong goal. The first question they ask themselves is, which property should I buy? They start looking at pictures on realestate.com or floor plans or locations, suburbs. But that's actually not the right question to be asking. The right question as a first-time buyer or investor is to ask, where do I want to be in 15 to 20 years' time? Because although you want your first property to be nice if you're living in it, the chances are it's not going to be your dream home, okay? It's not going to be the 4-bedroom waterfront mansion. It's likely to be maybe a 1 or a 2-bedroom apartment. So don't get too focused on the short term. Think about the long term and then step back from there to understand how you can get to that bigger goal of 15 to 20 years. And a great way to do that is to do some simple maths. And again, this is something that we can do with you. Not everyone is necessarily financially has a financial mindset. So this is something that we can do. But from a retirement perspective, how much income do you need per annum to make your lifestyle comfortable? From there, we look at, okay, so let's say you want an income of $100,000 to replace your salary so you can retire. How many properties do I need to own in order to have rental income of $100,000 per annum? And then that might be 4 properties, it might be 8 properties, it might be 2 properties. And then we need to think about, okay, how many years is it going to achieve this? Now, usually we like to say that you want at least 4 properties outside of your home, and you want to try and achieve that within a 6-year period if you can. So this is just our 4 steps to success, our preferred strategy, but again, it will ultimately depend on who you are, your individual circumstances. So, but this is our 4-step process. First is making a commitment, understanding what your long-term goals are, and here we've said 4 properties in 6 years. You then want to plan out the types and timing of each property. So you want to look for sort of a 1-year gap so that each year you can buy a property, settle it, and get the cash flow working for you. Step 3 is then to take immediate action and to get on the ladder. Buy that first property, do what you have to do, and make the leap, jump into the market. And the final step is ensuring to stay active, sticking with your goals, and trying to get those 4 properties within a 6-year time period. And then once you've got those 6 years, the goal is to hold, okay? And this is something that many investors get wrong. They build a portfolio, but they get bored, they get impatient, they may not see the growth that they want within the first few years, and so they sell. But the important thing is to be patient, hold on to the assets, and over time, history has shown that the markets will grow and you will make some great money, which will enable you to retire and hopefully retire with a really, really strong cash flow situation in your retirement. Okay, we're getting towards the end, final few slides, and then we'll call it a night. I am conscious of time, so we'll get through this quickly, but how can we help you? How can Ironfish help you invest in property? Well, this may not shock you, it may shock you, but 9 out of 10 Australians do not invest in property. They do not invest in real estate, and many more than 9 out of 10 do not invest successfully because they don't buy enough real estate. So most lack the knowledge and many lack the time to do this, but that's where we come in. We're here to provide you with the knowledge that you need to invest confidently in the markets across the country, and we're also here to save you time, so that we do the research, we analyze the projects and the properties so that you don't have to. We're here to make this as easy and as simple for you as possible, so you can spend more time doing what you love, whether that's spending time with family, friends, or out on the water, or whatever it is that you may be into. So we provide these 4 key areas: market research, so you can understand what's happening in the markets; investment strategy, how you can get to those 4 properties as quickly as possible; property selection, so we have house and land, townhouses and apartments across the 6 capital cities from some of the best developers in the country; and then portfolio management. We help you hold on to that asset or that portfolio over the long term. So we'd love to have the opportunity to speak with you. I'll put this slide up one more time, and then we'll have time for a Q&A. So if you have any questions, guys, please do type into the chat box, and I'll be able to answer 2 or 3 questions before we call it a night. Really appreciate your time this evening, and we'd love to be able to speak with you very soon. So please do jump on, scan that QR code, book an appointment with us, a free, no obligation appointment. We're here to help you, and you're all right. Let's go to a Q&A. Let's see if we've got any questions that have come through. All right, it looks like we've had 1 or 2 come through. Let's have a quick look, and then we can call it a day. All right, let's see. Okay, great question from Nathan. Nathan, thanks for your question. I'm worried that with interest rates increasing, I may not be able to afford the property that I'm buying. So this is a really common concern that we see among first-home buyers or first-time investors. Because they're not used to interest rate movements, they're nervous that if interest rates go up, they may not be able to hold onto that property. Now, this is something that you need to speak to a professional about to understand, okay, if interest rates do go up, how is that going to impact your cash flow? And perhaps how much can you afford interest rates to go up? Now, the banks will actually, when they give you a loan, they will look at your situation and they will actually make sure that you can afford much higher interest rates than you're paying. So let's say you get a mortgage for 5%. The banks will actually say, they'll actually put 3% on top of the 5%. do some calculations and see if you can afford to hold that property. So the banks do a lot of the heavy lifting for you, but nonetheless, it's important for you to understand what that may do to your cash flow, because it may mean that you're cutting down on your lifestyle. So maybe less holidays, less new clothing, maybe you're cutting down on your personal coffee consumption for the week. So it's really important to understand that. And one way to mitigate potentially interest rates going up is to get a mortgage with a fixed interest rate period. So you might look to fix your mortgage for 12 months, 24 months, 3 years, or even 5 years, so that you know exactly what your cash flow is from a mortgage perspective over the first few years of owning the asset. So thank you, Nathan, for your question. That's a great one. Let's have a look. We'll do one more and then we will call it a day. Okay, another great question. Thanks, Lee Tao, for your question. I'm concerned that the media is talking a lot at the moment about the market softening and maybe prices coming down. I'm concerned that if I buy now, maybe it'll be cheaper tomorrow. Well, there are two things to talk about here to put you at ease, Lee Tao. The first one is that if it's a quality property, there is always strong demand for quality real estate. So if you can find the right property that you'd like and you think is a good quality asset, buy it. And I know that I've certainly done this in the past when the market hasn't looked as strong. I've bought assets. I still continue to buy because I found a property that I believe is really, really excellent and will continue to outperform over the long term. So firstly is finding a good quality property. And the second one is that most of our viewers here tonight, first home buyers, first time investors, they're likely going to be at the more affordable end of the property market. So they might be looking from $500 up to $1 million to spend. And at the moment, there is huge demand still for properties at the affordable end of the market. And we are seeing the affordable end of the market be far more resilient than the more expensive end of the market. And that is because there's not enough real estate in Australia at the moment. The rental markets are very tight and people can't find a place to live. So there's lots of competition for more affordable product. And we're seeing that that side of the market is being very resilient and actually not dropping or only dropping ever so slightly. So I wouldn't let that be a concern for you, Lee Tao. As I've said before, listen to people with experience and who have built a property portfolio successfully. So thank you, Lee Tao. Thank you, everyone, for being with us today. We really appreciate your time. We hope it's been a valuable session for you. We look forward to seeing you again soon. I'll leave this final slide up. If you do want to book an appointment, we'd love to have a chat with you. No obligation, completely free of charge. Scan the QR code, book an appointment. Until next time, thanks so much, everyone. William Mitchell signing off for today. Have a lovely day, and we'll see you all again, hopefully very soon.